Welcome back to the channel. Today I'm going to be talking about pensions. So if you like this video and think it delivers more value than usual, then drop one of these to help beat that YouTube algorithm. So there's been a lot of news recently that's suggesting that pension ages can increase, and I think this is very likely. We have an article here from This Is Money titled, "Aged 43 to 54, you may have to work longer. Dismay over rumours of state pension age hike to 68 in 2035 as warning is sounded over small savings." They suggest here that men and women's state pension age is now 66, but it is due to rise to 67 by 2028. They also suggest that the next hike to 68 could come sooner than expected in 2035. A plan to hasten the state pension age rise to 68 by 2035 has sparked warnings that ill and poor people and carers will bear the brunt of the hike. Younger generations are also likely to struggle, as industry analysis reveals the state pension plus minimum auto-enrollment savings means they will barely scrape together a decent income in old age. Men and women's state pension age is currently 66, and between 2026 and 2028 it will rise again to 67. However, the government have reportedly announced an earlier than expected age increase to 68 as suggested, which will impact those born between 1968 and 1979. And it comes at a time when warnings have been sounded that generations due to retire in decades will come to face a gap between the income that pension savings and that of state pension will provide to live a moderate retirement. And in all, I kind of agree with this article. It's suggesting here that state pension age is increasing. There's going to be a shortfall between the private pensions and that of state pension. So you as an individual will have to deal with this. And personally, I'm not someone who relies on the government to provide for me. I know at the end of the day, because I'm a young guy, I'm 23 years old, that it's very unlikely state pension is going to exist. If it does exist, it's going to be in a completely different shape or form when I am at the eligible age. Therefore, it's not wise to rely on that for me. Great, it might be good if it's still around at that age and I may benefit from it, but the likelihood is it's not going to be around and it's going to be cut away. So what can I do, or what can you do as someone obviously looking to retire? What can we do to really bolster the savings? That's really the question we want to be answering today. And we've got some concerns here, right? Government are certainly pushing auto-enrollment. It's suggested later in the article, we can see where it suggests that the minimum auto-enrollment ages here, or the contributions, is not enough to retire. The article suggests here 6 in 10 risk missing out on adequate retirement. The state pension is not enough to live on comfortably, and current auto-enrollment contribution levels are too low. Savers are being warned. Now, this suggests that we're going to have to do other things in order to bolster our retirement. Firstly, your minimum eligible auto-retirement, and obviously you've got this auto-enrollment, which starts at age 22 at the moment, is 8%. This, in my opinion, is not enough if you want to have a substantial pension pot size, and so you're going to have to adapt in order to overcome this. And in order to do that, you can increase your overall contributions, or you can use various other tax shelters. Now, don't forget, the government are going to push for these auto-enrollment pensions so that then the future government can identify who has a sizable investment pot and who doesn't. Then there's likely going to be some eligibility criteria that suggests, okay, this person here called Oz, he has a £300,000 pension pot, and therefore he is not eligible for state pension because he is deemed survivable based on the amount of investments that he has. Instead, what they'll do is they'll say once that investment pot is gone, then he may be eligible to use state pension. Whereas at the moment, individuals are able to combine their savings through their current pension alongside state pension. It allows them to add them together and get almost a good amount of money so they can live a little bit more comfortably in retirement. And again, what it really suggests here is that meaning that only those that are truly broke will potentially get access to state pension in the future. And there's no point relying on being broke in the future when you have time on your side and you're able to prevent that from happening, fingers crossed. Now, this age will likely continue to increase. It's very likely that we're going to see the state pension age increase, as well as private pensions. This is something that has been a long-term trend. The idea here is that the aging population, or let's say the lifespan of a human, has increased. And whilst it's slowed down in later years, it's certainly increased since the first time these retirement ages were suggested. Therefore, it's wise on behalf of the government, if they want to increase their overall tax revenues, in increasing the retirement age. Now, this sucks sucks for individuals like you or myself because this means we will have to work for a longer period of time. And this especially sucks for those that are working in physical labor jobs in which you are very limited, and obviously your body at that point may not be as good as it was 20 years prior. But an aging population means a less, or suggests for a less productive workforce, and therefore they're going to have less tax revenue in the government. So therefore they're going to have to adapt for this, and by pushing up the age, it seems like a very logical solution to what problems they are currently experiencing. So again, solution, right? What can we do as individuals to bypass this state pension increasing, right? Firstly, let's not rely on state pension whatsoever. Let's hope it's there, but discount the idea of its effectivity. At a younger age, you've got a lot of time to invest now. I would personally invest first. So when you get paid for your salary through wherever you earn your income streams, that money should be automatically removed out of your bank account. Now, let's say a portion, let's say 20% is a random figure. Obviously, the higher the percent that you save and invest, ideally the better in the longer term. But let's say 20% of your salary is immediately moved out of your bank account the moment you're paid. And this goes into an investment broker. Now, this investment broker invests it in an all-world ETF, or an exchange-traded fund that tracks the global stock market that is widely diversified. Vanguard offers such a fund with low fees called VWRL, or VWRL, that's the ticker, and the name of it is the Vanguard All World ETF. Now, by setting this up and paying yourself first, it means you don't even realize psychologically that the money was there, and instead you now have the remaining money to pay down your bills, and then you might have some discretionary or disposable income at the bottom that you can continue to live and enjoy life, obviously. But this now means that you're pushing money aside, and that's good. Maximizing your employer contributions to obviously your pension is also a wise idea. However, it should be noted that this age will likely increase as well. At the moment, I think it's going to increase to 57 as of 2028, and this may be obviously a much greater age by the time someone like myself will go to retire. Therefore, my pension pot is not my primary investment vehicle. This is not what I'm going to rely upon at all, especially because they have a lifetime limit of around about £1 million as well. This means that if you do very well in your investments, you're going to be taxed a lot if you reach over that lifetime limit, and that might not be worthwhile for some more tax efficient investors. I strongly believe that an ISA, or an individual savings account that is designated as a stocks and shares ISA, is something that every individual needs. Now, obviously there were a lot of fears over the ISA lifetime cap, and there's a video about that in the top right of the video, but that's not important here. If you're able to invest your money tax-free for now, and let's just assume that it stays around in the future, this gives you the ability to build up your savings significantly. If you're able to save and invest and keep doing that over the longer term, then your growth is allowed to compound tax-free, so that when you withdraw it, it's still tax-free, and you can withdraw at any age. This effectively means that at the age of 50 or even earlier, if you've invested and saved enough, that you can actually retire at a much earlier time. This removes the restriction of the government. This removes that state pension requirement, that private pension requirement, and you are truly in control of your finances. Now, this is no easy job by all means, but if you look to maximize your income and really focus on improving your income streams, then you'll be able to save and invest more. Now, some people go the opposite end of the spectrum here. They want to save and invest more, so they look to live more frugally or cut down costs. I think, well, this can be effective in some way, shape, or forms. You're decreasing the quality of your lifestyle eventually to save pennies on the pound, when in reality, the best thing you can do as an individual is look to maximize your income streams, so that therefore you can save and invest more and maintain a good quality lifestyle that doesn't make you miserable or depressed from saving so much. As said previously, I prepare for a worst case situation in which the state pension will not be around for an individual like myself. Therefore, I invest in long-term equities in the stock market. You can view my portfolio here on the screen. We can see that at the moment I hold 3 core stocks. I hold Boohoo Group, Games Workshop, and the London Stock Exchange Group. Now, this is rapidly changing. I'm looking to add 2 or 3 more holdings to the portfolio, as I made a mistake from not diversifying enough. And you can see here that in the last 1,026 days, I'm actually down 45%, which is not good by any means. However, I'm hoping that I've learned quite a few of the lessons that have led to this large drawdown, especially at an earlier age in life, so that let's say in 10, 15, 20 years, this pot will be so much bigger, and I'll therefore be able to draw down upon this if I would like to. I don't have to. That's the beauty of this investment portfolio. It gives me that financial independence long term and potentially freedom to go, okay, you know what? I'm not happy where I am. I can draw down the portfolio temporarily whilst I look to do something that fulfills my needs as an individual. Thank you for watching. Have a fantastic day.